I retired from high tech at the age of 48, so I've been trading for about 26 years. So I got to enjoy a really nice early retirement. Anybody retire before the age of 48 in here? No, not yet? Okay. I had one friend that did it at 38, and he lived to 96. Trading style. So I'm willing to take a minimum loss. So you're going to hear some stuff from Jack, which is really cool, about his J-Safe stuff. But for me, I'm willing to take a $10 loss for a $100 gain, right? Or if I can keep it less than $10, I'll take it. Some of the trades I do are just like $1, kind of $1 or $2 losses, and then I get a good gain out of that. But I have to write special software to do that. But with age, I really want to minimize my downside risk. I'm 74 years old right now. You know, they say move more of your money out of stocks and into bonds and that kind of stuff. Well, I'm living with somebody that hits that home to me regularly. So my asset allocation is bonds. I got about 25% bonds and CDs. I have about, I do buy and hold. Jack, you're going to hear later, he got me into, he calls it a J-Safe trade, and it got me into gold, and I'm up 20%. Really nice. Cool. I like it, Jack. And then I have trading a section, which is basically 72%, and I go between trading and cash. I want to be able to get into a position really quickly, and I don't want to have to liquidate a lot of different things. So that's how I do my allocation. I was hoping the other people would tell how what their asset allocation was. Some people don't feel comfortable doing that, but for me, it's like I want to show. One of the things that's really cool about this group is I not only show the things that worked, but the things that didn't work. Things that didn't work, most people come back and say, "Hey, Ken, you could have done better." Like you heard with Brian, you know, he's talking about the lizards trades. Well, could have just bought SPY. Really good idea. So my claim to fame is a thing called a case stochastic. It triggers my active trading, and it's designed to front run all of the people that I learned from, the industrials people. So basically, before they get into a trade, I'm already in it. And then when they get into the trade, they got 10,000 of them. So what happens is that the price moves up really quick after that point. So I kind of like that. I don't know how many people in the room are using case stochastic. Anybody? Okay, a few people here. Okay, cool. And I use it for trading my Roth IRA, and I trade the triples, the SPXL, TQQQ, and TNA. And this is the, you're probably not going to see this on the internet, but this shows the trades for the TQQQ over the past year, and it shows the equity curve, and you can see the bottom one is the profit or losses of those individual trades. So if you look at a profit and loss curve, an equity curve, you see that if you buy and hold here on the left, you see that there's these tremendous drawdowns. For my personality, it doesn't work. I do not like drawdowns. I hate drawdowns. And so, but for somebody that does dollar cost averaging, that's okay. It goes down, they buy more, and then it goes back up. I think that's a really bona fide way of going. However, when you use that with TQQQ, you can actually get really negative. You can actually lose 80% of your, if you had it all in that TQQQ, you could lose an 80% drawdown. I wouldn't go for that. You take $1 million and reduce it to $200,000. That doesn't work for my retirement. So I use the case stochastic. This is the results of the case stochastic, and it shows a minimum drawdown. And this is with compounded growth. So over the same period of time, this made about just over 100% in 1 year. The problem that I have is, see this one big spike here, this one big drop? That sucked. That was December 18th. I don't know if anybody remembers that date. That sucked. Well, it really messed me up on the TQQQ. I lost a lot. But on the SPXL, it got out at the top. So every one of them trades a little bit differently using my case stochastic, but on the whole, it works out pretty well for me. Other trading that I do, like I said, I do the J-Safe that Jack is going to talk about here coming up. I trade individual stocks once in a while, and I do option strategies, verticals, iron condors, selling puts, and then buying calls and puts directionally. I'm not going to get into some of the really crazy esoteric stuff here. It's way beyond anybody here. I made one presentation at one of Jack's previous meetings, trading day of expiration options. It's wild. You can almost like gambling, but the returns are phenomenal. So the results, my net results on all of my accounts. So I basically take everything I had over the past year, all my savings accounts, checking accounts, stock accounts, everything. I gained 0.5%. As long as it's positive, I'm okay for retirement. This is not great, but you could see that if I would have put all my money into TQQ with the K stochastic, I would have been up 100%. That doesn't happen because if it goes bad, I don't have a recovery. So what I learned is I got too much experimentation. I spent a lot of time doing some of these other crazy little trades. Some of the trading is just way too complicated. I write software to minimize my complexity for my brain, but it takes a lot of work to write the software. Right, Richard?
That's correct.
So Richard teaches a class on TradeStation coding. So he's going to talk a little bit right at the end here, or see him if you want to learn more about TradeStation coding. Also, Michelle keeps on telling me, you got to get into more fixed assets. You got to get more fixed assets. You know, you could have done a lot better. And so you're going to see what the results are of somebody that's got a little more experience than I have in some of this stuff. So other online resources. So you got excess profits for presentations. Download the transcript, the ThinkScript code. So a lot of times, a lot of my code came from Larry Williams. Larry Williams said, hey, do a blast off. And he explained how to do the algorithm. I wrote it in TradeStation, and then I turned it over to Brian, and Brian took that and he turned it over into ThinkScript. And then I had the K stochastic, and I wrote that, and I tried to do it in ThinkScript, and then I didn't do very good coding. And then I turned it over to Tim, and Tim turned it around and made a really, really good implementation of the K stochastic on the ThinkScript. So it's a great community. And then go to Ken.Excess Profits for TradeStation code. It's all free available. Just download it. I'm not going to support it, but you got to be able to read the code. And then there's a YouTube channel which goes through all the different excess profits stuff. So if you go to that one at the bottom, you'll see, and just click. If you go to the one that's online, just click on it, and you can see all of the presentations that have happened before. So, quick question. Yes.
You choose like the TQQQs, the triples.
Yeah.
Okay? And I haven't unpacked this for a while, but probably about 8 years ago I had looked at that, and what I found is a real negative expectation when you go into the triples. A mathematical, you know what I mean? It's expensive. I found that they degrade because of the mathematical algorithms or whatever that are involved in it. And I wanted to ask you, when you look at, I like things that are cheaper, you know, they're more expensive. I look at options. I don't like too big of spreads. I look at all that stuff in percentages. I want to ask you, between going with the triples versus futures, do you find...
So one of the members of our group, his name is Ed Stefan. So if you go back and look at the excessprofits.com, you're going to see the K stochastic applied to futures.
Okay.
And so that you'll see tremendous returns there. Absolutely tremendous.
Yeah.
My problem is every time I tried futures, I lose. It's a really complicated system,
Right,
but I have a hard time with it. And as far as the TQQQ, if you just held TQQQ and it goes up and down, up and down, and up and down, at the end, if the Qs would go up and down, at the end, TQQQ would be down. So it works great in the upward side. So if you can buy it on the upswing, that's what the K stochastic does for you. It gets you on the upswing. All right, so I'm going to go on to the next presentation here. I'm trying to stick to the schedule here, guys. And let's see let me see who is going to be next here real quick.
Michelle.
Yeah, the one after the, I need to get this thing wired for the next person.
Michelle.
No, Michelle, I'm gonna do it for Michelle here. Hold on a second. Agenda, okay, Jack. Jack, can you wire yourself here?
Oh. You're gonna electrocute me?
Yeah, hopefully not. All right.
Am I next?
Yeah, you're good. Well, I'm doing Michelle's presentation now. You're going to be right after this. Okay. All right, and we're off here. All right. So Michelle has a finance degree. She's been in the investment firm for 43 years. She's got more experience than I got. All right. So she specializes in asset allocation. That's what the big guys do. The guys that come in with $100 million or something like that, they asset allocate. So she's got a lot of this experience. Willing to throw down to $5 million on the stock trade. It's like I would be shaking like a leaf putting the trade in. But she retired 1 year ago, and we met a guy who used the Tasty Trades thing, trade often, trade small, TOTS, right? So her asset allocation is basically, she's got small amount in cash, 7% in trading cash, she's got some in buy and hold, and then she's got bonds. So bonds and CDs are what she basically keeps her money in. She keeps on coming over to me and she says, Ken, you got to use something of that money. You got cash sitting there. You can't let it just sit there. Well, I'm going to trade it. I'm going to trade it. Well, and then a month or two later, it's still sitting there. It's not the smartest idea in the world, right? So she's sitting on my shoulder. I got one person sitting on my shoulder and saying, hey, this is a better way to do it. So I learned from everybody. Thank you very much, guys. So her trading style, she hates to lose on any trade. She's willing to hold and sell premium to recover. She has extensive use of fixed income for idle cash and most experience trading any stocks. You name the ticker, she'll tell you the stock. And right now we're using the case stochastic to find higher probability trades. So Tushar passed away this past year, and a little choked up about that. He showed us a technique about using it to find trading opportunities. He had this really cool scanning technique. And so what I did is I adopted it for what Michelle wanted to do with using the case stochastic. So that's, like I said, Tushar was one that generated some opportunities. His software is still running. So if you can find the thing on the internet, you can actually still see his recommendations for what stocks to trade, what stocks to buy. He has a buy list and a short list, a long and a short list. So Michelle's also taken some option strategies right now. So now we're getting into a little more esoteric stuff, guys. Okay, so that's all the stock stuff. Now we're going to start moving into more of the option stuff here now. She takes small positions, TOTS, trade off and trading small, and she's using the case stochastic to enter the trades. We have a auto scan technique on the Thinkorswim platform, and all of her trading is done in a retirement account, either a Roth or an IRA, because it's a nightmare every year. Bill, if you see Bill Barmeister here, he'll tell you how tough it is to deal with all the different trading in a retail account and the CD worth of trades that you're going to be dealing with. It's a real nightmare taking it to the IRS. So trading style, did that. Okay. So she's traded hundreds of trades in the last 6 months. Her maximum capital used was $20,000. The return on capital annualized is 40%. So you look at her trading list, and it's just a maze of stuff. And she's doing well. I can't knock it. Cool. Just got to increase the position size. So other trading, so she's doing vertical, so she's doing option stuff, right? Vertical, selling puts, buying calls and puts. And then she's following Dan Kaufman. Don Kaufman.
You guys remember?
You want to get the microphone?
Yeah. You remember Don Hoffman?
Yeah.
Yeah. So many people here know Don Kaufman from the early InvestTools days. And he had an option trade that just ended yesterday, a butterfly,
Yes.
and SPX. Did people know about that one? Gene, did you take it?
No.
She did.
It was amazing.
So I've never seen a trade where the price is up here for SPX and he's betting it's going to go over here with a butterfly.
Yeah.
And I was like, why? I don't know. And so it did. It actually did. It actually went where he said it was going to go. She made 6 times on his money. He made 5 times. In the end, it could have been 14 times. But, most people are happy with 500% gain, right? Or in her case, 600% gain, right? So to me, it's amazing to be able to see somebody that can do that kind of a thing. Especially when you saw when he put the trade on, it did not make sense to me. So one of the things for Jack's presentation, so Jack's group does a lot more option stuff. And the San Diego Trader Group, so we got San Diego Trader Group, which does a lot of stocks and stuff. And then Jack's does a lot of stuff with the options. So I'm going to hopefully make a presentation on that coming up in one of the other follow-on meetings to your online meetings. So, really cool. So stretch goals, utilize tremendous leverage of options, and start increasing the size of trades.
And that's what I need to do, is decide that I made the 40%, but it was not on a very large amount. So I'm working on increasing the size of my trades now, so.
Yeah, but between the two of us, she's retired, I'm retired, it's kind of fun. She's in one room, I'm in the other room, we just go walking from one room to the other room. Oh yeah, you just eat this one? Oh yeah, Don Kaufman said this, oh yeah, cool. Kind of fun, I'll tell you, it's a lot of fun. But the net income on all the accounts, after you take all of the pluses, all the minuses and stuff like that, is 5%. So it's not bad, like okay, it's going to get a lot better here coming up. So any questions for Michelle? Yeah, Gene.
Okay. I was listening to Don Kaufman before I came here. And he was talking about the bonds going down.
Correct.
So how are you handling that?
I'm not doing any bonds. I have CDs.
That I do, but I have been watching everything he's talking about with the bonds. And that TLT, he's looking at,
Yes.
getting into that, yeah. But I haven't, I do mostly CDs. I haven't done really any straight bonds,
Okay.
so, yeah. Fixed income is about it.
Cash right now.
Yeah, cash, money market funds, yeah, CDs, yeah. That's kind of what my fixed income is right now. But I did have bonds until it started going down.
All right. So this is Jack Beiser.
Hello, everyone.
You got your mic on?
Do I have my mic on?
No.
No.
Oh, I have to turn it on?
Yeah,
All right.
you got it.
This is it?
Yeah. Sorry,
Start dancing.
cell phone's off. All right, so slideshow, current slide. Yeah, all right.
Sorry if my mother's in LA and if I get a alert, I may have to refer to my phone. Okay, so how many of you have heard JSafe? Oh, wow, cool. How many of you are doing JSafe? Okay, cool. So JSafe came about almost a year and a half ago, and I have done well over 100 JSafe trades with real money, and I've been constantly working on improving it, even though the original JSafe still works. Okay, and basically it's an insured trading strategy, and we expect to make a lot of money. It is the best way of that I know of building wealth sustainably and reliably. Okay, it's not the fastest way, but it is one of the most sustainable ways of doing it. So, again, standard disclaimer, I'm not registered. I'm not supposed to be giving trading advice. I'm not. This is educational purposes only. You can read the rest. I want to get to the real bone of things. So, Ken referred to risk, and to me, that's one of the most important things I look at in trading. For me, the main purpose of trading for wealth building is not to make a big profit. And you're going to say, Jack, are you crazy? We're all here to make money. If you don't want to make a lot of profit, what's the point of trading? It's not. To me, the most important part is managing the risk. Because I've been trading over 30 plus years. I've lost enough money to buy some real estate a couple of times. And what I can tell you is, when your strategy works, everything is great. But if you're not carefully managing risks, it can wipe out your account. So as I'm getting older, I cannot replace the money I made. So I have to watch it. I have to be careful. So what I try to do is manage the risk first, and then try to make as much as possible within that managed risk. Okay? So, and if you got a decent strategy and you manage your risk, your profits will make you a lot of money. And I'll show you a way on how to do that. So, the premise of JSafe, the original premise, is when we buy a stock, we're usually taking more risk than a potential profit, right? The drawdowns could be big. JSafe provides higher returns than the risk we take. That's the fundamental shift. For example, SPY over the last 30 years or so makes a little under 10% a year, okay? Even though it's done really well over the last couple of years. Even with that, it's about 9.86% a year. But SPY had a 50.8% drawdown. How are you going to feel when your money is half? Remember we had the saying when all the 401ks became 201ks? Okay? We lived through those times. I don't want to live through it. JSafe turns it upside down. So basically with SPY, you're taking a $5 risk or 50% risk to make $1 or 10%. JSafe turns it all the way around. You take $1 risk to make $5. Very different approach. So by managing the risk, I'm still making good money, but I'm not taking a big potential loss. Now, having said that, it doesn't mean you can't lose money. You still have that dollar at risk. So you have to be careful. Okay. So JSafe itself is not a new strategy. Okay, the basics of JSafe is based on collars, which is basically using a protective put and selling a short call. Okay, now it is my version and actually Jay's version. Jay here, let's recognize Jay. He's the original. He's the person who originally put that idea in my mind. We've worked on JSafe for quite some time. I do a lot of research on JSafe, and I bounce ideas off Jay as well. He is one of the best traders I know of. So, what is this is a slightly different version than what I have on the jsafe.net site. By the way, this presentation a little bit more is on jsafe.net. You're welcome to take a look at it. There's no registration, and It has been viewed by over 100,000 traders so far. That's just word of mouth. I don't do any advertising. There's no revenue there for me. So it seems to be resonating by people. But the basic version of JSafe is, we buy a high growth stock. Actually, if you're ever interested, take a picture of the slide. There are 2 slides that are very good, and this is one of them. So we basically buy the stock. You're buying an in-the-money put. That's a little different. Used to buy out the money, but it's in the money put, 2 strikes above typically. Okay? So time frame, usually 6 months to 2 years, could be 3 months. Depending on your time horizon. Then we're selling an out-of-the-money 30-strike call. So we have the stock, we have the protective put, and then we reduce the cost of the put. Okay? You can trade it till expiration, and as price goes up, you can roll up the put, eliminate the risk, okay? And actually lock in profit. So let me give you an example. So this is an example on Meta. There was a signal, and again, you still need to look at the charts. You still need to look for stocks that are supposed to be going up because you're still taking a small risk. Okay. Here's an actual trade. We're taking, we're buying the stock at 344 and a change. 344, 350 is one up, 360 is the 2 strikes up. Okay, so we're buying a 2-strike put, and we're selling a 460/30 delta call. Now, the stock is 344. The put is extremely expensive because these are volatile stocks. At $50, you're paying $5,000, a lot. Very expensive. It's almost 15%. And if you just bought the put, like a married put, the stock has to go up more than 15% for you to be able to make money. So that's expensive, and that's why I like to reduce the cost of the insurance. And I do that by selling the call. And when I sell the call, I'm getting over $20 credit. So they're giving me this money. So my cost is about $30 on the insurance. Okay. If you want to calculate, and this is what really makes it work. I'm a very numbers-oriented guy. Numbers have to make sense to me. So I always want to know what's my risk, and I always want to know what's my max profit. Okay. So this is a little boring, but crucial information. So my max risk is $1,464. How do I calculate that? I take the cost of the trade, which is $374 and some change, right? And then my risk, my insurance is at $360. That's my put strike. So I take the $374, subtract $360 from it, and that's my risk. If you hold the trade till the end, you will not lose more than $1,464. It doesn't matter if there's a World War III. It doesn't matter China attacks the U.S. It doesn't matter if there's a meltdown in the U.S. As long as the stock market is there, you are protected. You don't care about gap down opens. You don't care about bankruptcies. You don't care about CEOs and entire executive team dying in a plane crash. None of that stuff, right? So stocks don't always protect you, but this put will, as long as the stock market is open. So how about the winning side? How much money can we make? Well, the calculation for that is very easy too. You take your call strike, which is 460, right? You're not going to make any more money than that. Your cost is 374. Subtract 374 from 460. That's your max profit. These are easy calculations, but they point to some very important facts. So my max profit is $8,530. Is it 30? 36, sorry. Okay, what does that mean? I'm taking a 3.9% risk to make 22.8% profit. Now, how many of you will be happy with the 20% profit? A lot of hands go up. How many of you will be very happy if your risk was only 3.9%? You're not taking huge risks, right? So basically, I always calculate my risk to reward ratio, and basically I take the max profit divided by max loss. So that gives me 5.1, or I'm sorry, 5.8. So I'm risking $1 to make $5.8, almost $6. You see, with SPY, we want to make on the average of 10%, but we're taking a 50% risk. With a trade like this, we're only taking, let's say, 10% risk to make 58%. Right? So this is the fundamental shift of what JSafe offers. And, you know, for people who'd like to protect their assets, to me, that's one of the best ways of trading. Okay? So taking the trades further, now I still have 3.9% risk, right? A $1,400 risk. Now, most of you, you know, trading this size may be able to live with that. I don't even like a $1,400 risk. So what do? When Meta goes up, I take my 360, roll it up to 370. Okay? So that probably, I have to do the math, but if you add the extra premium and a reduction of max profit, then, you know, this will probably take down my risk to maybe 2%. I do it one more time, roll it from 370 to 380. What does that do? Take out the entire risk in the trade. Now I'm not trading with any risk. Maybe even locked in some profit. Isn't it wonderful to be able to trade with no risk in the market and looking at high returns? That's what JSafe does. Okay, then let's look at another esoteric JSafe. Okay, that's an F-cell. So this stock was at the time trading for $1.44. What I liked about it is I could take the 1.5 strike put, and it was cheap, and 30 Delta was at $5, right? So I put together a trade, and on December 19, 2023, we bought the shares of F-Cell for about $1.44, okay, and bought the put at 57, sold the call at 15. My cost is $186. Almost anybody in this room can afford a trade like that, and of course we did multiple lots. So max risk is 36, max profit is $314. Okay, what does that mean? Risk to reward is 8.7%. Sorry, 8.7 times. So I'm risking $1 to make almost $9. Now guys, this is phenomenally good. Making 218% return ROI, right? It's a fabulous trade. Or is it? Pay attention to the next chart. Look at the chart. Okay? So the trend is down. No sign of sustainable up move. Just because the stats look fantastic doesn't mean you should take the trade. The chart patterns will always and always dictate whether you want to take that trade or not. It's not just a numbers game. The price has to go up because you always have a little bit of risk. Okay? And if you know more about how to read chart patterns, please take a look at my book. It's on Amazon Kindle. I don't make money off it. I wrote it for, you know, people who want to learn how to read charts. It's 99 cents, and if you have the Kindle Unlimited, it's free. That's my community effort. Okay, you talked about adjustments when we're talking about the meta trade. Now, JSafe is a very, very complex strategy. I know well over 1,000 different ways of forming it, and probably almost 24 management techniques. So I can't teach it all, but this is one very easy one that you could do, which is you're rolling the put up. When the stock goes up 10 or 20%, like on Meta, maybe, it went up from 344, especially my put is at 360, it's well above the 360. I can roll 360 to 370. Always make sure the price you're rolling to is always below where the current price is. Otherwise, they get very expensive. But that's okay. From 344, we're predicting it'll go to about 460. There's a lot of room for growth there. So roll your calls, roll your put, at least get your risk out. And that way, you're trading with no risk. But always calculate your max risk, max profit, and risk to return ratio. Know that before you get into the trade to make sure it's worth it. Never pay more than 50% of the wing width, because then it's like 50-50. You're not gaining much benefit from it. All right? So, what do you do at the end of the trade? There are 3 ways to trade with it. Okay? Unless you decide to end the trade earlier. So, A, price went much beyond 460 that we had, which Meta did. So we would be assigned. Now, a lot of traders are concerned or even afraid of being assigned. That is one of the best things that can happen in JSafe. Because what happens is you got assigned, they took away the 460 call, and they took away your stock. Okay? The only thing you got left is a long put. So you made your max profit, and you still have your long put, so you get rid of it, make a little extra money, so you make a little bit more than max profit. This is a gift the market can give you, but it doesn't happen often. And even when the price is well above the 460, you're not going to get exercised. Okay? It takes quite some time because of the time value. So the second thing is, you've got your put, you got your call, somehow the trade expires when the price is in between. So if the price is higher than your cost, but you made a profit, that's great. You can still keep the stock or sell the stock. Or if you keep the stock, you can do another JSafe because you got some profit in there. Your cost is less than what the current stock price is at. Or the worst has happened. You bought stock where your cost was 100, the stock went down to 50 or 25. People are pulling hair, and you're still smiling. Why? You have a protection at 100. So what you do is you exercise your put. Okay? How many people have exercised options? It's not commonly done. Okay. So on toss, right-click on the strike, exercise. In Schwab, they automatically do that for you at expiration. So this is similar to calling the insurance company and making a claim because you lost your house on the fire, as many people will do very shortly if they haven't already in LA, right? So you say, my house burned down, I've got it insured at that point, give me my money. They say, sure, we'll take your stock, which is at $50, and we'll pay you $100 for it. You got it. So you've incurred your max loss, and hopefully your max loss was nothing because of, you rolled up your put, and you get your money back. How great is that? Right? So, this is something I added. As I said, I do a lot of research. Never satisfied with what I've got. I'm always trying to tinker and see if I could improve stuff. So I ran a Monte Carlo analysis, which was Tushar Mangrola's favorite. He was a very close friend of mine. We worked on a lot of strategies. So I said, what if I make 20% on winning trades and I lose 3% on the losing trades, okay? And maybe I have a little better chance of making money. Like instead of 50-50 coin toss, what if I have, I make money 60% of the time, lose money 40% of the time? What happens after 100 trades that are very randomly picked? Well, here's the interesting stuff. If I do that, 60 wins, 40 losses out of 100. The ending amount is $16 million after 100 trades, assuming you're rolling the money into the next trade. Okay. The worst scenario is I lose 2% to 98,000. So to me, that was really a mind-blowing thing. The potential for ruin is zero. You cannot deplete your account with this strategy. All right. One other thing, we started talking with risk, and just like you could see on the caricature, risk tolerance is different for different people. Just you got to know what your risk tolerance is. Giraffes can go into deep water; it's not a big deal, but rabbits cannot. So you got to set up your trades in the way that works for you. When I'm coaching, that's one of the first things I try to understand. What is your risk tolerance? So that we can put trades together for your risk tolerance. It doesn't matter if the trade makes a lot of money. If you're taking huge risk and you can't sleep at nights, that's not the right strategy for you, in my opinion. I want to sleep comfortable. I want to sleep easy. That's why I gave up day trading. Okay? Even though positions were liquidated, it's just too stressful for me. But I love this. I don't care. I had a large position in AMD, for example. It was doing extremely well. It's doing really bad. Okay? Even some of the trades where the current price is lower than what I entered, those trades are still making money for me. Right? So I don't have to worry about the AMD goes down by 5%. The effect of it on my sizable AMD position is maybe a couple of $100, right? So that's me, that's how I work. Lastly, JSafe, in my opinion, is a much safer strategy than buying stocks. JSafe 2, the one, 2 strikes in the money, is even better, he's even safer. So, but you got to use the calculations here and to determine your risk, your reward, and risk to reward ratios. I have a spreadsheet for it. If anyone is interested, just send me an email and I'll send it to you. Just understand the behavior of the stock. Not every stock is going to do well. For example, for SPY lovers, JSafe doesn't do 5 to 1. Okay, because the volatility isn't there. But if you're happier with a lower return, that's fine. On a big up year, JSafe isn't going to return the SPY results, but it will protect you, will give you one of the best protected insured risk reward awards. I don't do it, but you can certainly do it. As I said, it's a very flexible strategy. I know of over 1,000 different ways of doing it, and I think I added some more ways. This 1,000 number is old, and there are various ways of managing it. This is the basic of the basics that I can teach you guys, and makes money, not guaranteed, but it's easy to put in. So there are many other ways of doing it, but not all of them are better than what the basic I showed you. I've had trades, results, I've lost the worst probably, maybe it's not the worst, I don't know, maybe 36% loss in a really bad, risky strategy. And I just closed one for my daughter. She made over 22,000% on that trade, right? So they can go crazy variant. But this is the safest, or one of the, this is one of the safest ways of doing it, and it's easy. That's what I was able to boil down to. Any questions?
Yeah, Jack, I love your strategy, because you can sleep at night, as you say. Right away, I look for holes in stuff, and that's probably a good thing. One is, you gotta be able to find stocks that are likely to go in a direction you can forecast reasonably, and I've got a technique for that. That's a no-brainer. But what I don't know that you could perhaps enlighten me on is is there an easy way to determine which stocks to focus on for the options? Because most stocks,
Volatile stocks,
very volatile stocks.
High implied volatility.
high implied volatility.
And where do I find out?
Go to Tasty Trade, they got a list of high IV stocks.
Or go to your Thinkorswim, if you have a Thinkorswim account,
Yeah.
then just go list the stocks, and you can have in your watch list, you can just have IV in the right column, and then sort them by high IV.
Okay.
Yeah. We need to get going to the next presenter real quick.
All right, I'm here for as long as you want.
Yeah. So, Nikki, did you want to say something or not?
It's like,
So Nikki has been around for since the beginning that Brian put the whole thing together, and so we've learned a lot of the stuff back and forth together, and she has a particular style, and just going to give a quick verbal update of what that is, and up there would be good, because then we can get people to see you. Old home week here with all these people. So, Tim, you want to drive up here too or not? Right after this? Oh boy, this is going to be interesting.
You want the back? You Indian giver, you.
Yeah.
that good? Okay, we good? Oh my gosh, so good to see some of you guys. I haven't seen you. Hi, oh my gosh, you guys. Okay, enough of this. So I'm totally unprepared. I apologize. And I thought this was at 11 o'clock. It's at 10 o'clock, so I was late. Anyway, I've been doing the same strategy for years and years and years. I didn't hear the whole presentation that this gentleman just did, but when I did come in, I'm hearing a lot of what I do. So I'm just going to give you a real quick example. So in August of 2020, I got assigned on Tesla. I had a short vertical put, 95.90. So, and I had 8 contracts. So I got assigned, so I had to buy it at 95, less the premium from the spread. So my cost basis was 93.33. So here I am, and I normally don't, I'm not an investor, of course we're all traders. I don't usually hold on to stock when I get assigned. So here I am with these 800 shares. So what I start doing is selling calls against it to get rid of it. And normally that's my intent, is to get rid of it, to get called out. But for whatever reason, I just kept hanging on to Tesla. So I started, and I sell my calls, I do 65 to 75% probability of being out of the money. So here I sell the calls on Tesla, and I sell when the stock is high. I'll sell when the stock's going up, that's when I'm going to sell. And I'll kind of wait and watch, and I do weeklies. So now it's coming up, so I'll sell like, say 65% above that. Tesla went crazy when, so I kept doing this for like years. I was doing it, trying to get called out, and I would never get called out. And then Trump wins, Elon Musk does the Doja, whatever it is, Tesla goes through the roof. So now I'm way down here on my short call, and it's up here, so it's like, dog, doggone it, why did I cover that? But, okay, years go by, well, years, yeah, 2020. So now Tesla's at, what's it at? 3 something or so. And I still have I'm covered on, okay, so I had 800, so I'm covered on 3 of them, because as it's going up, I'll start going, oh, I don't want to cover too much, and I'll roll. I'll keep rolling. Every week, I'm rolling. If it's going up, I'm rolling, rolling, rolling. So now I'm really covered on 3 of them down at 320.
Tesla.
Oh, perfect, okay. So, yeah, I'm covered like at 360. Doggone it, look where Tesla is. It's like at 394, and it was up to, oh my God, it was almost at 500, and I'm going, doggone it. But I still had, see, I had 8 covered at 3, so I still had 5 that I'm making money on. My cost basis was $93, so I'm happy, you know, it's making money. Could have been making more if I was more on top of it. And okay, so I'm really lazy. I don't like do all the records. I used to that way back when, but now I don't. I'll look at my phone. I've got, now it's Schwab, but pops up on my phone. I look in the morning, where are my positions? Is anything crazy happening as the stock's going up, up, up? And I'm going, doggone it. So then I'm selling all this time also. So if my call is down here and Tesla's way up there, I'll start selling puts and say, come on down here, come on, come and get me. And I'll just keep doing that. And then if it comes down, there, my call's making more money, I'll roll the puts. And that's what I do, roll, roll, roll. I usually will sell naked puts because, I mean, I guess you could do verticals, but I've got portfolio managing, so naked puts work out just fine. And so that's basically what I do. I just keep, let me see what I wrote.
How long have you been doing this?
Oh my God, when did we, okay, we started like in 2005, right?
Yeah.
So, and the last meeting I went to was years ago. Oh my gosh, so I've been doing it for years.
Niki has online, if you go to excessprofits.com and look for Niki, you'll see Niki's presentations and when she started doing some of this. She was doing it on Priceline before.
Yeah.
And have you given up Priceline?
Well, it's now Booking, and I do have Booking. So same thing with Booking. So I got assigned, same strategy. Okay, that's when Trump, the same thing, Booking and Tesla. So when Booking screamed way up high, and I got assigned 100 shares. I had 1 contract. So it's covered, my cost basis right now for my 100 shares is 40.60. And I think Booking it's way up. So it did a shoot up to the sky too. I was covered down low. So now my coverage, because of rolling, I'm covered at 43.50. But look where Booking is. Like, when it went up in the 5,000, I'm going, doggone it, I should have uncovered that. But it got so far away from me, and I thought, it can't keep going up, right? So I didn't buy it, I didn't uncover it. It's like, shoot. And every time I look at that, I go, doggone it, I should have uncovered it. But I'm fine because I'm still making, it's still profitable. And I'll just keep rolling. I roll when it comes down, and then I sell that's when when it comes down, I'll roll that short call. And then when it's, no, erase that. When it's up, okay, wait, let me look. Okay, so, yeah, when it's down, I'll roll the short call. And I'll buy the put. I'll buy a put because it's coming down and I want it to come down. So I'll sell the put down there. See, I'm so unprepared. I just do this automatically. It's hard to tell you what I do. But anyway, yeah, roll and sell, roll and sell. And basically, when it's coming down to my short call, which is what I want, because then I can roll it up and make a little bit more money. I'll sell that put way down there, and it's, even though it's very far, because I'm not gonna say, I'll get nothing for a put at 43.50 where my call is. I'll get pennies, so I'll go up like, like maybe right now, maybe 45. I look at the percentage, so I'll do like 65 to 75% probability. And I just keep doing that, and that's what I've been doing forever. Sorry, I'm so unprepared, but I'm very busy. Yeah.
How far out in time do you choose strikes?
Oh, I go weekly, so I'll just go a week. Now, since with booking, I'm covered so low, in order to get a premium, because I want to do it for a profit. I don't want to do it, I don't want to take a negative. Sometimes I'll have to go out the next week. But I do weeklies. I'm very, very short term.
But don't you ever get a sign like where your shares taken away by the short calls and going to money? Or you just roll?
No, I'll roll it. So I'll normally roll, once in a while, I think I did get assigned on a different stock. I did get assigned. But they took it, it's fine, because I was still profitable. So it wasn't a negative, because every time, because when I get assigned, now I'm selling the call up. So if I do get assigned and they take that, I've made money on that. But I'll look on Thursday, and I'm familiar with my stocks that I'm doing it with. And so I'll look on Thursday and say, should I roll? How close am I? And I'll either roll on Thursday, and I'm really bad for this, don't do this. I wait till the last minute. I want every 5 cents. It's like I don't take the profit when I have profit. I wait. I want it to expire. And don't do that, because it's not a good habit to get into.
Bill Burmeister, does that sound like somebody familiar?
There's a question on
Is that
that,
what you do?
and that is, how far out are you going with your expiration?
What week?
Weekly. I just do
What
weekly.
is each roll monthly?
What is
That's
each
what it
roll?
says. And what is each roll monthly? Nick, you might have to explain that question.
So it's just, she rolls it weekly. Everything is weekly.
Okay, everything is weekly.
Yeah, the only time I don't do weekly is if I can't get enough premium and I have to go out to the next week, but I don't do monthlies at all.
Okay. We go on to the next. Thank you very much, Nikki. I appreciate it. I'm going to set up for Tim here.